Let's be honest and just call it. Options can be confusing, right? So let's just keep it simple. And we're going to talk about two main options that you have as a trader. When you're options trading, you do have many different types of instruments at your disposal, right? But for the most part, we can sum it up under two categories: equity options and index options. But what are they? Which one's better for you? Well, in this video, we're going to break down equity and index options, their benefits, and what factors to consider when you make your decision. So an equity option, think American style options. It's a contract that grants the holder the right, but not the obligation, to buy or sell a specified number of shares of stock at a specific price within a specific period. Equity options, they're traded on various exchanges in the United States and around the world. And the shares underlying an equity option, they can be stocks, ETFs, or even REITs, which are real estate investment trusts. The underlying instrument of an option contract is 100 shares of that instrument. So, for example, one options contract of Meta would contain 100 shares of Meta stock. And there are two types of options. There's call options and put options. The call option will give you, the buyer, the right to buy the underlying security, like Meta. Well, a put option would give you the right to sell it. And the price at which you can do all of that is called the strike price. And the strike price is the price that you expect the underlying instrument to be above for a call option or below for a put at expiration dates. An expiration date, all option contracts have them, and that's when they are void. And the expiration date for most equity options is the third Friday of each month. So using this Meta option chain, notice that green highlight. We're going to talk about call options. The strike price is $145. The expiration date is for January 20th, 2023. And the last transaction was $14.50. So just for an example, let's say you want to buy this call option using the last transaction. It would cost you $14.50 per share, or $14.50 times 100 shares for $1,450. So as a trader, you want the stock price of Meta to be above $145, and then plus the premium that you paid of $14.50 by expiration in order for you to make a profit. If that option is exercised, and really only 7% of contracts are exercised, the shares of the stock are exchanged between the buyer and the seller of the option. So if you hold a Meta call option and you exercise it, 100 shares of Meta stock are transferred to you from the seller of that option. And if a put option is exercised, and shares of stock are transferred from the buyer to the seller. Now, most traders are just going to sell to close their positions before expiration and book a profit or a loss depending on what the underlying instrument has done. Index options, very similar to equity options, except that instead of shares in a particular stock or an ETF, an index option gives the holder the right to buy or sell shares in the entire stock market index. Well, the most common index options are based on the S&P 500. Now, most index options are called European-style options, and unlike equity options, index options can only be exercised at expiration. And that expiration day is the Thursday before the last Friday or the third Friday of the month. The settlement price, the exercise price, is known the next business day around the market opening. Here's the difference. When you exercise an equity options contract, you would receive the shares of the underlying. But with index options, you would receive a cash settlement for the intrinsic value of the contract. All right, so for example, let's say the S&P 500 index is currently trading at $3,670, and you have a strike price of your call option at $3,675 at expiration. And if it gets there, the intrinsic value is $5 or $500 per contract. Another really decent feature of index options is because they're composed of different underlying companies, they're less volatile than just trading an individual stock. So when some of the underlyings are moving up, others are moving down. And this can offset some of the extreme volatility you can get when you trade just a singular underlying asset with an equity option. So what are the benefits of equity options? You get a high degree of control and flexibility when it comes to managing your portfolio. You can get out of them whenever you want. They can be used to hedge against risk by offsetting positions in other investments. Also, they offer opportunities for traders to profit from both rising and falling markets through calls, puts, and various other option strategies. Benefits of index options: exposure to a large number of stocks with a single investment. They tend to be more liquid than individual stocks, meaning there's usually zero problem finding a buyer or a seller when it's time to get out of them. And they're often less volatile than trading an equity option. So what's better for you? Equity options? Index options? Depends. It all depends, whatever your investment goals and objectives are. So if you're looking for more control over your portfolio, maybe the ability to hedge against risk, equity options might be the better choice for you. If you're more interested in gaining exposure to a large number of stocks with a single investment with potentially less volatility, index options, they could be for you. And when it comes to choosing them, there's no clear-cut answer, right? It all depends on your investment goals, your objectives. Now, because equity options offer traders considerable flexibility and opportunities to make profit, they're actually a very popular instrument in today's market, and they're a favorite here over at NetPicks. So I hope this video just gives you a better understanding of these two types of options so you can make a more informed decision about which one is right for you. Of course, you want to seek investment advice before you risk your money. And also, let's imagine just for a second what it would feel like to have that power over your financial future. That's what options trading can do for you. Give you the ability to make money regardless of the market conditions. And right now, they're not the greatest. So for you, here's a link to download our free options cookbook. It's also in the description. And this is going to give you an inside look on how we successfully approach options trading here at NetPicks. Thanks for watching. Make sure you subscribe. We'll talk to you soon.